Hey, what's up guys? It's Jonathan here, back with another public stock portfolio update. So as usual, we're going to do a quick recap of some of the moves that we made in the portfolio this week. Then we'll also do a recap of how the portfolio is doing overall. Then we'll talk about a couple important things that affected the stock market last week and that can affect the stock market moving forward. So with all of that said, let's get right into it. So as usual, we deposited $10 into our public account. We did do quite a bit of buying this week. And as always, if you guys want to see me make these trades live, check me out on Public. I have a link in the description below. If you sign up with Public using that link, you get a free stock worth $70. So if you're interested, check that out. So on Wednesday, we did quite a bit of buying. We bought some NVIDIA. We bought about $3 in NVIDIA at $242.99 a share. In my opinion, that's not a terrible price for NVIDIA, especially given that it fell from its all-time high of around $310. So I like NVIDIA at that price point. Another buy that we did is we bought some Tesla. We bought about $3 worth of Tesla at $881.16 a share. Tesla at that price point, it's not necessarily my most favorable price point, especially given the kind of market conditions we have now. Anything under 1,000 long term isn't really a bad price to buy in my opinion. Then we also purchased some Amazon as well. We bought about $2 at $3,050.24. I like Amazon a little bit better if it was under 3,000, but this is within 2% of it, so it's still not really a bad price to buy in my opinion. I think Amazon's going to have a lot of headwinds with the supply chain shortage and the possible rise in oil. We'll get more in depth into oil later. So we also bought some Etsy. We bought about $1 worth of Etsy at $162.82 a share. Like Amazon, Etsy is also struggling with the supply chain issues and the rising cost of shipping. So it does make sense why their stock hasn't been down. But I believe sometime last week it was somewhere in the run 10. So if you were able to buy it, then that was a really good time to buy.
We bought some SoFi.
Well, we bought about $1 SoFi at $11.67 a share. SoFi is currently an unprofitable company, but they are planning on becoming profitable in the next couple of quarters. I think that this stock will probably stop some of its bleeding once we get to that point. The only thing with SoFi is that they are facing a rate hike cycle in front of them, which usually doesn't favor lending companies. But we'll get more into detail about that later on in the video. So then on Thursday, we bought some Tesla. We bought about $2 worth of Tesla at $837.30 a share. Tesla in the low 800s, I think, is still a pretty good price as well, so I was able to buy a dip on that on Thursday. So now let's go into our iPad and do a quick recap of how the portfolio is doing. So currently the portfolio is valued at $208.71, and it's down about 20%, and we currently have about $30 worth of cash on the sideline, just in case if the dip keeps dipping. So the first position we have here is Tesla. Our Tesla position is down 3% now. I remember there was a point where Tesla was down much more than this, so it's good to see this bounce back in Tesla. It currently makes up about 20% of our portfolio. In this kind of market, I like the growth companies that are profitable. So the companies that you're seeing me buy, like the Tesla, the NVIDIAs, those kind of companies, I like buying these kind of markets. That is why Tesla is one of the biggest positions in this portfolio. I really don't mind adding onto it because in my opinion, I don't think Tesla is as risky as what people think it is. I think that the company is much different than the days where we'll see like a 10% drop in the stock price in one day. I think Tesla, in my opinion, is a pretty safe bet. Next position we have here is Enphase. Our Enphase position is currently down about 2.5%. With Enphase, they are going to face some headwinds coming with supply chain shortages, especially given everything that's going on in the world right now. But I still think long term that this is a good company. The next position we have here is Etsy. Our Etsy position is down about 17.5%. Like I said, they're struggling because of supply chains as well, especially with what's going on in the world right now. So that's another company that I think we're going to have some patience with to see it really start to move to the upside. Next position we have here is NVIDIA. NVIDIA, it's currently down about 10%. It makes up about 8.5% of the portfolio. Again, high margin, good products. Very high demand. I really like this company long term. Next position we have is Google. Our Google position is down almost 8%. You know, Google, again, I think in my opinion, it's still a pretty safe play even though we are down 8% on it. It's one of the biggest contributors to the S&P 500. So there's a lot of money that will flow in and out of the stock over time, but I don't think you could go wrong with Google. Next position we have here is Robinhood. Our Robinhood position is now down 60%. Like I said, with rising interest rates, it doesn't favor fintech very well. So this pain is probably going to persist for a very long time. But currently, it makes up about a little over 7.5% of the portfolio. Next position we have here is Amazon. Our Amazon position is currently down about 13% and makes up about 3% of the portfolio. Like I said earlier, with Etsy, Amazon, supply chain issues, cost of shipping going up, they're going to struggle for a little bit until we start to get a handle on inflation. Next position we have here is Cloudflare. Our Cloudflare position is down almost 18%. It's a software company, has very high valuation. High valuations and rate hike cycles usually don't fare well, so it is what it is, but that's what's going on with Cloudflare. Our next position is Trade Desk. Our Trade Desk position is currently down almost 10%. Advertising has taken a beating recently, so that's probably why we're seeing some of the pain in Trade Desk and even in Google as well. And currently makes up a little more than 2% of the portfolio. Next position we have here is Matterport. Our Matterport position is down almost 57% and makes up about 2% of the portfolio. With Matterport, they are an unprofitable small cap company, so they are seen as more riskier. In my opinion, I don't necessarily think that's the case. I think Matterport can be a really good bet in the future. So again, with Matterport, we're gonna have to be patient as they transfer their business model over from a hardware side to more of a software side. So that will cause them to have some pain in the next couple of quarters. Next position we have here is SoFi. Our SoFi position is currently down about 25% and makes up about a little under 2% of the portfolio. It's the same thing with Robinhood. Fed rate hike are really kicking the stock down. So next position we have here is Palantir, another software company that's down 52%. It makes up about 1% of the portfolio. Like I said, another software company, high PE, high valuation. The market doesn't like it at this time. Next position we have here is Redfin. Our Redfin position is currently down 60%. Real estate doesn't like high interest rates. It's a headwind to the entire real estate market. And since Redfin does represent the real estate market to some degree, that's why we're seeing all this pain in Redfin. The head of the Federal Reserve, Jerome Powell, testified on Wednesday and Thursday in Congress. And during this hearing, he did take a more dovish stance on rate hikes. And he said that he's looking to support a 0.25% rate hike in the March FOMC meeting. And this was mostly driven due to war and the economic uncertainty that's being caused by the war that we're seeing in Ukraine. I think the Fed is worried that if they act too aggressively and this conflict or this war, whatever you want to call it, goes away pretty quickly, it can actually take the legs out of the job market and end up with an economy that has high inflation and high unemployment, which is pretty much the definition of stagflation. I think that's why we're starting to see a more relaxed J. Powell recently. And he followed that up by saying that the Fed is ready to react quickly if needed to curb inflation. If for whatever reason, a lot of these uncertainties that are currently in our market start to dissipate very quickly. Now, off of this news, the markets did respond pretty positively to it, given that basically the half-point rate hike in the March FOMC meeting is all but ruled out at this point. Speaking about the war in Ukraine, when it comes to oil prices, Russia is one of the biggest producers of oil in the world. I believe they supply about 12% of the world's supply of oil. JP Morgan is currently predicting that we could see oil hit up to $185 a barrel. And to put that in perspective, oil currently costs about $115 a barrel. As of the day I'm filming this, which is Sunday, March 6, 2022, there is more talks that United States and United States allies may put a ban on Russian oil. And this is why we're starting to see a lot of these price predictions of super high gas prices. This has a massive effect on inflation because almost every part of our supply chain relies on oil. And if we end up seeing a $150 barrel on gas, that would cause CPI to increase by 2%. Given that we just got a 7.5% reading last month, another 2% on that could easily drive us to double-digit inflation. So that is something to watch out for. What happens with a possible ban on Russian oil, how that will affect oil prices in the near future. The Moscow Stock Exchange was closed all of last week. This was mostly to prevent something that I like to call a stock run, where it was expected that there's going to be massive selling pressure in their stock market exchange. So to avoid that, the Russian government decided to shut down the stock market. This can create liquidity problems for companies that need the money from the stock market to be able to run their businesses. So it'll be interesting to see if it opens up this week finally. The Russian central bank hiked up their federal funds rate, like what we call the federal funds rate in the US. They hiked it from 9.5% all the way up to 20%. It'll be interesting to see what kind of effects that has on their market. One thing I did want to state out there is that if you're buying the dip on any Russian ETFs, I really implore you to be very careful because a lot of those ETFs are not trading off the values of the underlying assets. They're actually trading this off of, I guess you could almost call it hopium. So there's a very good chance that once the Moscow stock market opens, that those ETFs could crash pretty significantly. So it's just something to watch out for. I mean, it could also be the case too that they could just go to the moon. So, I can't give you financial advice, but I'll just say if you have money in there, I would just treat it like it's the roulette table and you could lose every penny of it. So that's basically all I got for you guys this week. Thank you so much for watching. If you enjoyed this video, please hit the like button for the YouTube algorithm. It greatly helps out the channel, helps push this video out to as many people as possible. Also, if you enjoy my perspectives and the way I explain things, consider hitting the subscribe button and notification bell so you get notified every time I post a new video. Let me know what you guys think about the markets right now and what you guys are looking at currently in the comment section down below. Also, check out all my social medias. I try to post there as often as possible. And thank you so much for watching. I'll see you in the next video.